When Howard Marks talks, Warren Buffett listens. So do so many great investors and analysts. What is Howard Marks saying right now?
Let's jump in today in terms of whether or not he thinks that we have a lot more room to run, or he, similar to Sam Altman, thinks that we might be in heady times where we might be about to see the bubble pop. Today on Altimetry Authority.
Let's talk earnings and favorite pastimes.
So let me just say, earnings
Wall Street
It's
Why do they
2.5
do that?
x.
Because their compensation goes up.
Wall Street's wrong again.
All right, Joel. So this week we saw a very funny headline pop up, which was Nvidia disappointing the market in terms of guidance, and yet the S&P 500 kept on going up. And as one analyst said, right, the Nvidia disappointment shows how this AI-driven rally in the S&P 500 can keep on going. Now, Joel, let's be honest, right? I mean, sure, of course, a sell-side analyst is going to say that because, you know, a sell-side analyst just wants to pump stocks higher. But this wasn't just any analyst who made that comment. This was somebody who maybe we should pay a little bit more attention to. Is that fair?
Yeah, it's Howard Marks. Now, Howard Marks has run Oaktree. He is one of the the stalwarts, the great value investors of the last 30, 40 years. He's written a couple of really, really great books. Even Howard Marks' letters that he writes, Buffett would say that when I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something. So even Warren Buffett says he loves Howard Marks' analysis. Well, all right, Howard Marks recently was commenting on it's early. It's interesting. He said valuations are beginning to look really expensive, but it's early. So it's an interesting way of saying, yes, the market is getting toppy, but not yet. Meaning, if anything, he's kind of saying if you compare again the AI boom we're in right now to the PC and dot-com revolution of the 1990s, the markets really took off in 94 and then peaked in 2000, and Nasdaq did 600% over the time period. What Howard Marks is saying is essentially that this feels like 1997 where, okay, things are beginning to look a little expensive, but man, this could still be early, meaning you might have another 3-4 years of this, and that's what we believe, is that the AI boom is going to create 3 or 4 years of a phenomenal trend. Sam Altman said recently that he thought things are getting kind of expensive, that the AI stocks, or AI valuations, and honestly, he could have been talking a lot more about venture capital than he was the stocks, right? Because I think in venture capital world, you have seen some crazy valuations on any business that slaps the 2 letters AI. Just like in the 1990s, all you had to do as a company say, oh, we're a .com. Anything .com could get an instant valuation, instant money with no revenue, with no business model sometimes. All they had was, we own drugstore.com, and suddenly drugstore.com gets some crazy valuation for, a year or 2 or more. So when we look at this, despite Sam Altman saying AI valuations are a little toppy, and we're not even sure if he's talking about stocks so much as he is venture capital and private investing.
Yeah, where he lives, exactly.
And then that's where he lives. And then the MIT paper, which was talking about a very small, tiny sample of AI investments where they said those aren't paying off, but it got interpreted to mean AI isn't paying off, when in fact they said a very, very, very specific sample of corporate AI investments isn't paying off. And yet the market, took it and said, let's take a hit. Now, this is one where, Rob, you're going to show in a second, but this is these are corrections that give you gifts of opportunity for the long term.
Right, to your point, Joe, I mean, when you think in the context of Howard Marks, right, one of the smartest investors in the world, saying, hey, we're 1997, and then Sam Altman coming out and saying that, I mean, Joel, I remember you and I talking when Sam Altman said that, and we go, that timing actually really worked, because it reminds us of another time that a person who maybe was missing the forest for the trees said, I don't know, the market looks really toppy, because all of you may remember Alan Greenspan's phrase, irrational exuberance. It's like one of the most famous phrases ever uttered by an economist ever, right? In terms of, and he said that in December in 1996. And when he said it, right, what happened? He sent the market into a tailspin, right? I mean, the market actually fell like 10, 15, 20%. Well, that was in 1996. As Joel, you said, we all remember where the Nasdaq went after that. And that's right in line with when Altman said this now. Just for everybody, by the way, these two lines, I know this looks like what the hell are we doing in terms of all these lines. That dark blue line, that is the Nasdaq from when Netscape Navigator was launched and released to the public in 1994 until basically call it 2.5 years later. And why did we do 2.5 years later? Well, because the light blue line is the Nasdaq from when ChatGPT 3.5 was released to the public in the end of November 2022 to today.
To today.
Look at those two charts and tell me those two charts do not look almost the exact same. And Altman and Greenspan speeches, not that far off in terms of timing of two people who are calling the top of a bubble when we all know where that bubble ended up going. But my favorite thing, Joel, was actually, it's always nice, Joel, when you get confirmation from somebody who's infinitely smarter than you that the way that you think about the world is a pretty reasonable thing. And when you and I read this, Howard Marks' comments about why it's 1997 to 1999, this sounded an awful lot, Joel, to me, like how you taught me to think about macro. So let's can you take everybody through what Howard Marks said in terms of why it looks like 1997 and 1999 and why he said you need to panic?
Many investors have lost so much money because they said, the market's expensive, I'm going to stay in cash. And then they watch the market get more expensive, right? Mm-hmm. Companies with P's of 24 can go to 26, can go to 28, can go to over 30. This happened in the 1920s. This happened in the big 80s. This happened in the 1990s, right? And even happened a little bit into 2007, just before the Great Recession, right? Valuations didn't get quite as crazy, but the fact is, valuation just being high or being so much more than usual or so much more than above average, like a price to earnings multiple, has never been a good timing signal, right? Not to mention, if you're using GAAP accounting, the earnings number calculation today is far more conservative than it was 30 years ago. What does that mean? That means that the earnings represent a lot less today of the actual cash generating ability of a company, right? Accountants are conservative people. They've gotten more conservative. So when people say, well, the price to earnings multiple is much higher, I'm like, is it possible maybe that your earnings calculation is actually lower relative to the cash generating ability of the company? And people are like, I had no idea. Well, they assume the accountants, right, have kept things steady for 30 years. No, it's earnings has gotten more and more conservative. So valuation or PEs are terrible signals for saying it's time to sell. Terrible, right, for saying it's time to sell. So price to earnings has never been a good signal of when to get out of the market, no matter how expensive it's gotten. It just is a bad when to sell signal, right? Which we totally agree with, and Howard Marks is brilliant in saying so, right? When they say what matters is just pure earnings growth that beats expectations, even if it's not that great, as long as it's better than people expect, surprises and whatever. Mm-hmm. And that is what we've been seeing. Crazy valuations just get crazier because earnings growth is growing. So Howard's right on that. We're totally in agreement that this is the kind of market we're in. Like 97 to 2000 is what we're in right now, of call it 2025 to, who knows, 28, 29, maybe 2030, right? It's hard to say.
And Joel, just put that in perspective for everybody, right? When Howard Marks says the idea of what matters is earnings growth and earnings growth beating expectations, this is on a uniform accounting basis where uniform earnings has been for the last 5 years. Uniform earnings has been growing 9% a year and is forecasted to continue that for the next 2 years. Right now, current valuations are only expecting earnings growth to be 7% a year. So Joel, even if we assume there's no acceleration in earnings growth, this sounds like exactly what Howard Marks was saying, earnings growth that beats expectation, we're set up for because the market is not pricing in 9% growth.
And you just see valuations just go up and up and up and up while companies are beating earnings and people are sitting there on the sidelines with money and cash, unfortunately thinking, it's going to fall, this is crazy, it's a bubble. And it's like, yeah, that's what everyone said in 97 also, and 96, and 98, and 99, as they got, they're just beaten up by being in cash while the stock market was doing so well, right? Not to mention, right, we believe that all of the independent research boutiques that we follow would show that inflation is actually well below what the CPI and the Bureau of Labor Statistics shows, where when you look at independent unemployment bureaus that we think we have a lot of faith in, there's several that we look at, they would all say unemployment is at or worse than anything the BLS is doing. And we believe Powell is coming around. We saw his speech recently, and that it looks like he's probably going to drop interest rates and he drops interest rates, it's going to be a boon for the U.S. stock market and for U.S. companies because it makes debt cheaper, and it makes more money left for earnings and more money left to invest.
And Joel, I mean, as we're saying, I mean, also not that dissimilar to what happened in late 1997 and early 1998, right? Because for those of you who don't remember, what happened was we had the combination of the Asian financial crisis and then Russia's default, and also long-term capital management's collapse. And in the middle of a bull market and a massive investment cycle, we cut interest rates. So we just poured lighter fluid on the economy.
Yep.
And that's what potentially is happening right now with Powell and the Fed's likely setup, right, Joel, in terms of being able to cut interest rates. And look, everybody, the one thing that Howard Marks highlights is the thing is we are, from a sentiment perspective, a bit extended right now, meaning investors are a little bit over their skis in the short term in terms of everybody being all in. So any bad data could cause volatility. But as long as that bad data doesn't disrupt that narrative of credit is getting easier and more accessible, and also earnings growth is being healthy, we're not seeing anything that points to the idea that this bull market is getting upset. And so that's important because, again, if we remember, Greenspan's irrational exuberance and Altman's AI bubble moment,
Right.
Greenspan's preceded, again, another 300+% upside if you had bought that day. The day that Greenspan said that, if you had never been in the market before, but you bought when Greenspan said that, you would have been up 300+% in terms of your performance for the rest of the 1990s, 600% for the whole entire bull market. We wouldn't be surprised if Altman's comment actually ends up being the same kind of setup in terms of where it is. So everybody, just don't be panicked about what Sam Altman is saying. Listen to arguably who Warren Buffett would say is probably one of the smartest operators in the market, who's telling you, yeah, we might have a few more innings left to go.
We are in a growth and momentum bull market, right? Where earnings growth, sales growth, investment growth rules the day, and people have to get comfortable with valuations like price to earnings multiples and price to book. That's going to get uncomfortable, just like it has at this stage of every bull market in the last 200 years.
Mm-hmm. Now, everybody, if you disagree with us, or you think that there is a company that is riding this bull market that's an awesome buying opportunity because of its earnings growth, drop it into the comments, and Joel and I, we might talk about it in a future episode and say whether or not, like Palantir, it might be a little heady or there might be an opportunity there. Drop in a comment and drop us a like and a subscribe. And this is this episode of Altimetry Authority. Thanks, everybody.
Thanks, everyone.